Hi Luke, given the macro backdrop and the recent asset class correlation and performance, why global multi-asset investing is favored in 2024?
First of all, we need to look at what has happened over 2023 before we can start to consider what next year's outlook is. And clearly 2023 has been dominated by monetary tightening across the globe, across central banks, in the pursuit of taming inflation. Now, to that end, we have seen rates, certainly from the Fed, at the highest levels that we have seen for more than a decade. And the impact of that, of course, has led to a degree of fear and concern across risk assets. Equities in particular have gone through certain wobbles, although as we come into the year end, we find ourselves in select markets showing quite a positive year. Now, looking forwards and taking into account the macro backdrop, the starting point for me is to look at our baseline expectations. And our baseline is that the US economy is likely to go into recession. Now, is that necessarily a headwind for risk assets? It could be. But if that recession turns out to be shallow, and if the Fed and other central banks can start to ease their monetary policy into the second half of next year, then that could be a tailwind for us. Now, within that, and certainly for our investors who are looking for a secure and sustainable income, having the opportunity to invest on a diversified basis, both geographically but also across risk assets, so equities, fixed income, etc., I think it's a powerful combination. And hopefully, should we be nimble and take advantage of opportunities as they arise, I think we're in a strong position to deliver both those elevated income outcomes that clients are looking for, but also the opportunity to generate positive capital return.
Thanks, Luke. In a higher for longer environment, how to harvest income with a multi-asset investing approach without sacrificing growth opportunities in 2024?
Yeah, so I think it's certainly the case that rates are going to remain at these elevated levels for some time. Now, whilst we believe the Fed is at peak cycle, there or thereabouts, it's likely that they're going to have to maintain the rates at the current levels probably into the second half of 2024. Now, what that does is afford us opportunity. We can be very thoughtful about which asset classes are likely to behave in that environment. I do think from a bottom-up security selection point of view, we want to be focused on quality. We want those companies which are less exposed to refinancing risks, so strong balance sheets, those with good cash flows, those which are less susceptible to a potential decline in consumer demand. Now, alongside that, of course, we need to look at the full opportunity set across the globe. Equities, fixed income in combination, and moving to those markets that offer better value. And in particular, I think where we can look there is certainly to the Asian markets. Now, whilst there is still work to do for China on the policy front level, China, Hong Kong equities, for example, have been something of a laggard this year. That could well reverse in 2024. So having that broad array of instruments, broad array of allocations, for me is critical to deliver those outcomes.
Thank you, Luke. Very inspiring. To conclude, could you provide a couple of key highlights and summarize why global multi-asset in 2024?
So, the main reasons for me, opportunity set. The world is a very different place for investing in 2024 than it has been over the past decade. I think the opportunity set is broader, volatility is likely to be higher. We also need to think about exogenous factors such as geopolitical risk. And multi-asset on a diversified portfolio basis, diversified within and across asset classes and across geography, is likely, in my opinion, to be the right path to deliver those sustainable outcomes that clients seek.
Thank you for sharing your view with us today.